Hi there and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Ward Bortz, who's the ETF Portfolio Manager at Angel Oak Capital Advisors. Ward, welcome to the show.
Hi, Sumit. Thanks for having me.
Absolutely. So, Ward, your suite of actively managed structured credit ETFs recently surpassed $1 billion in assets under management. I want to talk about your funds, but first, can you tell us a little bit about yourself as well as Angel Oak?
Yeah, so maybe I'll start with Angel Oak. We are a $17 billion fixed income manager. We date back to the financial crisis where we took advantage of the distressed opportunity with hedge fund strategies. Ultimately, we ended up launching mutual funds and actually a mortgage originator. We're actually one of the largest originators of non-qualified mortgages in the US. And in total, we manage $17 billion with everything from ultra short, high quality strategies all the way to, leveraged private credit strategies. Generally, all of them are focused on mortgages or mortgage-backed securities. I joined the firm about 2 years ago to launch our ETF business. Prior to that, I had worked at large asset managers like Dimensional Fund Advisors, Invesco, and BlackRock, really focused on the intersection of active investment products, investment strategies in equities and fixed income, and passive, or at the time it was primarily passive and really the only thing that was available in ETFs. And I really got excited about the idea of managers with differentiated expertise launching active ETFs. I pitched it to the leadership at Angel Oak and joined the firm 2 years ago to launch it. I think our goal was to raise $200 million in the first 24 months, and we're at $1 billion in 20 months. So it is a lot better than we expected, and I'm excited about it.
That's amazing. You've absolutely seen tremendous growth. And one of the ETFs in particular that has seen strong growth, Ward, is the Angel Oak UltraShort Income ETF, ticker symbol UYLD. Can you tell us about this fund?
Yeah, so the kind of genesis of the strategy, and really any strategy we build, is how can we take our expertise, which is securitized credit, and use it to solve an outcome that we think investors are missing. In the ultra short space, so these are fixed income strategies with a duration of less than one. We found that particularly in ETFs, it was difficult to find higher yielding ultra short strategies, and securitized credit. So that's things like mortgage-backed securities, asset-backed securities, CLOs. They tend to be a way where you can get very high quality, short duration assets and a relatively high yield. And so we launched UYLD as a way to deliver that higher yield, high credit quality within an ultra short strategy. And, it's been pretty remarkable, the uptick that we've gotten on the back of really what it was not that long ago was just a concept.
And is that yield advantage, Ward, the primary advantage of this ETF versus, say, money market funds and other ultra short-term bond ETFs?
Yeah, I think what we're offering for investors is if you're currently in cash, we hear all the time, I'm getting 5.25 in money markets and I'm thrilled about it. The kind of interesting thing is that because so many investors are just taking their very short duration stable assets and putting it in money markets, there's not demand for those assets that are very high quality and short duration. So last year, I think the fund returned 7%. I think it's on track for around 7% this year as well. So there's a pretty significant premium offered for being willing to go out the curve a little bit, right? So going from a duration of 0 to say 0.8 years, and down in credit quality a little bit. So instead of being in money market, you're in, say, AA credit quality. You can get a significant premium for kind of just moving out a little bit. And so, what we've been able to do is talk to investors about the fact that, you're currently in cash. This is a way for you to kind of dip your toe in. And the response, clearly given the growth, has been pretty awesome. And I'll say that the second use case has been investors who are in other ultra short ETFs. So they've kind of already made that decision that they want to be in, say, corporates, short duration corporates or short duration treasuries. They want to move out the curve a little bit. and realize that, for similar or even better credit quality relative to other ultra short strategies, they can get a lot higher yield with securitized credit. And so we've seen a lot of demand from really those two places: other ultra short strategies moving into our ETF, or cash or money markets moving into UYLD.
That's really interesting. So Ward, we've talked about UYLD, and if I'm not mistaken, you have 3 other ETFs currently on the market. Can you tell us about those?
Yeah, so when we think about our platform, we think about kind of a spectrum of risk and return. So on the bottom left, where we have the kind of lowest credit risk, and is going to be UYLD. If we move up the spectrum, we will move to MBS. The ticker's MBS. It's our the Angel Oak mortgage-backed security ETF. There's a tremendous opportunity right now in mortgage-backed securities. They're trading at very high yield because of the increase in interest rate volatility we've seen post 2022. That has caused agency mortgage-backed securities and non-agency mortgage-backed securities to trade wide. We take advantage of this in our MBS fund ETF. We launched this in February, and it's already doubled in assets. I think that this could be our biggest fund in a year or two, given the kind of pipeline we have and the demand we're seeing. So very excited about that. Moving out a little bit further, we have CARY. That is kind of our multi-sector ETF. Here, we're going to be going down in credit quality a bit, more of kind of a triple B type exposure, out a little bit from a duration standpoint, a duration of around 4. And here we're going to be looking to invest kind of a little lower in the capital structure, get a little bit higher yield, a little bit higher risk and return profile, for investors who are looking for yield and also, not interested at all in being in cash, but want a little bit of duration. And then the last ETF we have is AOHY. We actually converted a mutual fund that we've had for 10 years. It's a top decile performance over the last 10 years. Really strong performance. We're going to allocate to high yield corporate bonds. The majority of the portfolio will be in that, but then also high yield securitized credit bonds, because that's kind of our special sauce, if you will. There we have an incredible track record because it's an ETF now. It's one of, if not the best performing active ETFs, and if you include passive as well, passive ETFs out there. And we just hit 80 million. It had been around as a fund for 10 years and had never gotten an 8 handle. And so we're already seeing growth there. And by the end of the summer, kind of given the pipeline that we have, we expect that to be north of 100 million. So we're really firing on all cylinders. And I think we've got, a suite of solutions that hopefully meet investors with whatever challenge they have. We have something to help fix it.
Well, fantastic. 3 really interesting ETFs for investors to consider. Ward, it's been an absolute pleasure having you on the show. Thanks so much for your time.
Thank you.